Hello everyone, welcome back to my channel. So in this video we're going to talk about the Vega and the Gamma and their own specific relationship. Just to give you a brief introduction, the Vega measures by how much the option price or the option premium changes when the implied volatility changes by 1 percentage point, and the Gamma measures by how much the delta changes when there is $1 or one monetary unit of change in the price of the underlying asset. And so both of these particular Greeks are measures of also risk, and in this case, as an option seller, if you are an option seller, these are both measures that work against you because you are collecting premium to be exposed against the risk of these two metrics going against you. And what we are going to see in later in the video is that, and because the Vega implies changes in the Gamma, what's going to happen is that you will see that the changes in implied volatility not only change how the options behave, but also changes the shape of the Gamma and how the Gamma interacts then with the option price itself and with the delta. And you will also be able to see later in the video that even sometimes when you sell options, sometimes the underlying price may not even move, but just because the implied volatility had a big change, your position can become much riskier than it would otherwise you would expect, just because there was a specific change in the implied volatility in your favor. And that's we are going to address now in the video. Alright, here we are. We're going to use our calculator again. I selected 5 different prices, spot prices, to do this analysis. We're going to use the $110, $106. We're going to use the ATM, meaning 100. We're going to also use the $94 and the 91, so that we can see across all different levels of moneyness, from being deep in the money to being deep out of the money, what is going to happen to the relationship between the Gamma and the Vega as we go along. And then we are going to use also, as before, 4 different levels of volatility: 10%, 20%, 50%, and 100%. For the time being, we can ignore this chart, this graph over here, because this graph will only be relevant when we shift the volatility. For the purpose of moving from in the money to out of the money, this graph is not really important. So, and as always, until this point so far in the series, 0 risk-free rate. We don't want the raw involved. Dividend yield also 0, and we are going to use again 30 days out to expiration, because we want to isolate as much as possible the effects between the Gamma and the Vega. So starting here with a spot price of 110, you see that because the stock is very much, the option has a delta of almost 1, the stock or the option is behaving pretty much like the underlying stock. And as a result of that, both the Gamma and the Vega are almost 0, because the stock does not have any Vega and does not have any Gamma. Now, if we go now towards ATM from 110 and 106, you will see that both the Gamma and the Vega start to rise, right? And at this point, it shifted still slightly so for both the Vega and the Gamma, but you can see now that the increase or the shift will be much more significant as we move in at the money price. And so you'll see as we move towards 100, we reached pretty much the peak, and at this point in time, the Gamma and the Vega are at their maximum. And from this point onwards, as we move towards out of the money, and in this case 294, you'll see that both the Vega and the Gamma will start to decline. So they move pretty much in tandem at this point, and you'll see that they came from a very, very low number to a very high, to a relatively high number when they reach at the money, but now they are going back towards zero. And as we move further and further out of the money towards the 91, you'll see that they are almost zero. And so let's now move to 20% volatility. And again, 10% is the volatility that you would have with the very, very low volatility ETF. For example, the TLT is probably the best example, the one that the ETF that tracks the 20-year or the long-term 20-year treasuries, US treasuries. Now, if we move again, let's shift again to 110, and let's move here to the 20% volatility. And I want you to see what's going to happen here to this graph, because this graph currently is very peaky, all right, and the tails are both very small, very narrow. And so the gamma is basically zero for most of the way of the spot price, and then reaches a very, very high peak over here. And now, as you will see, as we increase the volatility to 20%, and again, 20% is, let's just say, the same as the small caps ETF, the IWM, which tracks the Russell 2000. Very stable individual stocks, low risk individual stocks. And you notice at this time that the graph, the tails of this graph have increased, and at the same time the gamma has become less peaky. So the maximum value is no longer 13 something as it was before, 0.13 as it was before, and now it will become the maximum, which is around 7, as you can see here, 0.07. And now again, because the tails are bigger, are fatter, the Vega and the Gamma have increased relative to what it was at 10% volatility. And as we go back again towards at the money, they increased further and increased more significantly, all right? And when they approach at the money, you'll see that the Gamma reached close to 7. The Vega remained the same. It was 0.1144, but now it's 0.1143. So this is pretty much the same Vega, but the Gamma, the peak Gamma has been reduced considerably because of this changing profile of the Gamma sensitivity. And again, as we go towards out of the money, you will see that now it comes down again. Still, as you recall from the previous graph at 10%, now the gamma is still higher, all right, relatively so. You see here, it goes from 0.0149 and now is 0.426. So when it is some way out of the money or some way in the money, you see that the increase was bigger, the number is bigger than it was before, all right? But then as we go very much out of the money, you see that even so it's no longer as close to zero as it was before. Now, moving on to a higher volatility level, and at this point we are talking about those higher volatility stocks, some tech stocks, mid caps, and so you'll see, and again pay attention to the graph of the gamma here, you'll see that the peak of the gamma is becoming lower and lower, and at the same time the tails are becoming fatter and fatter and fatter. and at 50% volatility you no longer have a gamma and a vega close to zero. All right, they are already material at this point, but at the same time, because the peak of the gamma is now less than 3, you will see that as we move towards the ATM, and again we're going to stop here at 106, the increase from $110 spot price 106 is no longer that much significant, and as we go towards at the money, you'll see that there was almost no difference. And as you can see also here, the peak of the gamma is no longer at this particular spot price. The Vega hardly moved. It was 0.1144 at 10% and 0.1143 at 20%. So the gamma, the Vega pretty much remained the same at its peak, but the gamma has become much lower. So, and now as we move past ATM and goes towards out of the money, you'll see that we reached here at 97, we reached the peak gamma, right? So we are out of the money by $3, and this is where the peak gamma is. So it's no longer at the money where we reached the peak. And now, as we move towards out of the money, the gamma hardly moved. And while the Vega continues to go down, but slightly so. And then as we go further out of the money, there is still some Vega and there is still some gamma. And this situation will continue to happen now on a even bigger scale on relative terms, because if we increase the volatility to 100%, and at this point in time we are talking pretty much about those small cap individual stocks, those small tech firms, those small pharma stocks or biotech firms, which have a volatility of around 100%. You see here, and again let's put here 110. You'll see here that the distribution, or not the distribution, but the graph of the gamma is no longer a peaky one, is much flatter. And now we have a peak gamma of 0.0151. So at this point, with this so much volatility, because the range of outcomes is so wide, being $10 above the strike price is no longer considered being deep in the money. And that is why with $10 above the strike price and a volatility of 10, we had pretty much an option behaving like a stock. Now it is anything but. It has only delta of 0.68. You see here that the Vega is almost at its peak, even though we are $10 in the money, and the gamma will not reach much higher than this. In fact, we are very close to the peak, and as we move towards 106, you see there was only a slight difference in the gamma. The Vega also hardly moved, all right, from 1123 to 1142. And as we move towards here, you see that peak Vega is reached not anywhere close to at the money. All the peak value of the Vega, and this is something that is also odd, the peak of the Vega is attained when you are still in the money, all right, but the peak of the gamma will be reached when we are already out of the money. And so we are still progressing towards the peak as we move at the money when it comes to the gamma, but the Vega is already over the hill, and we are already going down on the Vega as we reach at the money. And now as we move here towards the 94, you see that we haven't yet reached the peak of the gamma. the peak of the gamma will be reached now somewhere. Yeah, we have to even go deeper out of the money, and this is where it stands. Yeah, it's at both of these prices, so we are very much out of the money. But in comparison, in terms of standard deviations away from the mean, given this volatility, we are still relatively close to the money, and that's why the gamma does not go down to zero. There is still Vega, and also there is still some delta, because the delta that exists would never have existed if we had a volatility, for example, of 10. You see, the delta would be zero, everything would be zero, because the option would be pretty much dead if we had a spot price of 89 with a strike price of 100. But because we have 100% volatility, the range of possible outcomes is so vast, so large, then this option is not considered to be deep in the money or deep out of the money by any stretch of imagination. And this is something that we need to keep in mind. So gamma peaks, or the gamma peak does not grow as volatility rises. It actually shrinks, continue the whole way as we go from 10% volatility to 100% volatility. And what actually happens is that the curve, or the gamma curve, flattens, all right? And so the curve, this curve is basically the wings or the tails of this graph catching up while the peak falls to meet them. And as you can imagine, the impact at this point in time, the impact of any additional percentage point of volatility will be marginally smaller and smaller and smaller. But if we just, let's say by absurd that we do this, you see that it becomes flatter, all right? The curve, the gamma curve, will become flatter and flatter and flatter, all right? At this point in time, it doesn't become any flatter than this, simply because the increment of 1% no longer makes a difference, and so this is where we basically stand when it comes to the differences between the volatility and the relationship that the volatility of the Vega plays in the gamma. And so the Vega in this case tells you a much more decisive or much clearer story when it comes to these strikes, all right? Because as you saw, at 10%, the Vega is already highest at the money and is very low on both the wings. Let's go back here to an acceptable volatility. At the wings, it's very much non-existent, but it's very high at the peak, all right, at the money. But then as the volatility rises to 50% or to 100%, you saw that it barely moves across the four levels at the money, all right, or close to the money. The peak does not change, but the wings or the tails of the distribution of the gamma, of the graph of the gamma, change. So the Vega also flattens because the peak comes down very, very slightly so, or almost barely anything, almost nothing at all. But the floor of the Vega becomes higher and higher as we reach more volatility. Because the volatility becomes so much higher, the option is still alive because of that volatility. The possibility of a large move is always there, and that makes the option never become fully dead, all right? And this is the main insights. They move in tandem, all right, but the gamma tends to become flatter, all right, and much more flatter than the Vega, because the gamma peak also comes down while the tails go up, but the Vega keeps the same peak while having the tails of the Vega going up. So there is always a bigger distance between the peak of the Vega and the tails of the Vega, or the peak and the bottom of the Vega, than it exists between the gamma, the peak gamma and the bottom gamma. The difference becomes much smaller as the volatility goes up. And of course, because this matters for example, the wheel, because you are just not picking out of the money puts for you to trade, or out of the money calls for you to sell covered calls on. This is important, because even if the price does not move, these changes in volatility may make your position change significantly. And this is something that I also want to show an example about. Alright, in this case let's use a split screen, because it will be easier to explain this situation, which is again what happens during a volatility crush and what is going to happen between the gamma and the Vega. Let's just assume again that we have a stock that has its earnings announcement coming up, and we are going to sell a put on that particular stock. And currently the put has 100% of implied volatility. We are 30 days out. The stock price is 106, and so we decide that we are going for 100 strike price, which is quite aggressive because it's not that far from the money, given that we are dealing with 100% volatility. But still, this is what we are going to do. And again, like in other videos, the difference between the gamma and the Vega for a call and a put option is exactly the same. So there is absolutely no difference. All right, these are the same numbers, so we can safely use this example with the put option, knowing that this also works with the call option. And we sell the put, the earnings come, and it turns out that there is absolutely no surprise at all. The earnings, the guidance came exactly as the market expected, and as a result of that, the price simply did not move. It remained at 106. The option remains out of the money. But then, because the earnings are now known, the volatility of the option will no longer stay at 100, and let's just say that it goes down to 20%. And you will be able to see here in the values of the gamma and the Vega that as I reduce the volatility, the gamma will go up, and at the same time the Vega will go down. And at this point in time, we reached by chance the peak of the gamma. All right, we are at this point in the Vega, but let's just assume that for a reason that I cannot imagine at this point, because this is as unlikely as it possible. Let's just assume that the volatility goes down to 10. And you see here that the gamma is going to be completely falling off a cliff, all right, very fast. And you see here that it falls at a much higher speed as the volatility goes down than when it came up, when the volatility fell from 100 to 20. Now, why this non-linear behavior happen? Why does the gamma rose when the volatility fell from 100% to 20%, or rose when the volatility fell from 100% to 20%, but then when the volatility falls from 20% to 10%, the gamma simply falls off very, very fast. And to explain why this is happening, I'm going to use this graph here on the left-hand side of the screen. So, as we know, because I already explained this a few times before, the bigger the volatility, when the volatility is high, that means that the range of possible outcomes, all right, of a particular option is very large, because it's very easy the standard deviation away from the center gives us a very, very large step up or step down towards other results. And that's the reason why if we have 106 spot price, we are not deep in the money with 100% volatility, but we are pretty much in the, deep in the money with a volatility of 10. All right, this makes sense. And as we know, when we remove volatility from the option, what's going to happen is that this large range of possible outcomes will become narrower. And I want you to pay very close attention to this dot right here, because this dot represents the spot price, all right, which is the same as we have here on the right hand side. And you'll see that as we go, remove volatility, all right, this dot will go up in the distribution. I'm going to go a little bit faster, and you see it goes towards the peak. But at this moment, let's just stop here for a moment. The gamma, right, increased, you see, because it went from 0.0124 as we had in here. It went up because, as you saw, the set of possible outcomes not only become narrower. This is one of the forces in play here as we remove volatility, but at the same time the distribution of possible results becomes peakier. This peak becomes ever and ever higher, and because of that we are at this point in the distribution. As we remove volatility, we are going towards the middle or the peak of the distribution, and that's why the gamma goes up. But then at a certain point in time, all right, when the volatility starts to become little enough to make sure that this option is more and more safely in the money, and the likelihood of becoming out of the money becomes smaller and smaller, as you can expect, when the deeper the option goes into the money, the more it behaves like a stock. And as a result of that, the gamma starts to go down because a stock has a gamma of 0. And so as we remove more and more and more volatility, you're going to start to see that this dot, which is a stock at 106, no longer is part of the likely outcomes of this particular option, because this option will become more and more and more likely to stay at the money, which is usually the starting point of it, you see. And so as we remove volatility, the gamma goes down, and at this point in time we are already on this side of the graph of the right hand side. So as we remove more and more and more volatility, the peak becomes peakier and peakier, but the option is because it has its underlying, it's 106, this option is becoming more and more and more in the money. And so as a result of that, I can also do this with a put, it's the same thing. And in this case it would not be in the money, it's out of the money. But doing the same example again, when we have a volatility of 100%, it's very likely, it's in this case with the likelihood of the stock, the option finishing in the money is 36%. But as we remove the volatility, you see that the delta comes down. So the probability of the option going over to the ITM side, it becomes smaller and smaller, all right? And so as a result of that, the option becomes more and more and more dead, because being 106 becomes a much larger distance towards the money when the volatility goes down, all right? And as a result of that, the gamma starts to go off a cliff. The option is dying because this 106 is becoming too far out of reach for this stock to ever become in the money. And so that's why at some point, as the volatility goes further and further down, the gamma just falls off a cliff, delta goes off the cliff as well, and for example at 10%, yeah, it's almost impossible. It becomes only a 2% chance this put option will ever become in the money. And so that is the reason why this happens. As we move from 100% in here, all right, as we move from 100% in here, the gamma, and we remove the volatility, the gamma increases. Why? Because the gamma is rising, so we are still under a set of outcomes in which this can become in the money, all right? It's still very possible that this put option ends up in the money with this much volatility, and because of that, the delta becomes ever and ever more and more spikier, all right? Because the gamma is increasing, all right? As we saw here, the gamma goes up. It goes towards the peak of the set of outcomes, all right? But then when we remove this much volatility and start to go into the low volatility territory, at this point the increments are already very, very, very small, are already marginally smaller and smaller. That's why at this point in time the dot is already falling down, because this is a derivative of this. The gamma is a derivative of the delta. So basically what happens is that as we remove the volatility, the option simply becomes too far out of the money to ever become in the money. And so that's why when we reach this level of volatility, the gamma goes out of the window and goes down the cliff. And so, as we can see here, what this actually means is that the dangerous situation for I'm talking about for those who trade the wheel. The dangerous issue here is not whether the implied volatility is high or if it's low. That's not the most important thing. The important thing is the zone between where you sold the option, in which we had 100% volatility, and where it lands after the volatility crushed. And so if you sold this put while the volatility was very high, around 100%, like I said, and the IV comes down but stalls at around 20%, what's going to happen is that your gamma becomes much higher. So you may think that most of the risk inherent to the stock or the option is now gone because the Vega has come down significantly because of the lower volatility, but some of this effect has been replaced by the increase. Some of this risk has been replaced by the increase in the gamma. And so you may think that this option has now become very calm, low drama, 15 delta put, but it can behave like a much more dangerous one, simply because even though the Vega is now lower, so the volatility now does not make much of a difference, the gamma is now higher, and this can reflect a more dangerous situation because the delta is smaller but now is much more spikier, and any change in the price, if it happens, is going to change the delta much more because of the increase in the gamma. And so really the safest outcome of the volatility crushing is going through all the way from the 100% that we mentioned, all right, to, in this case, to this side of the set of outcomes, which is in this case achieved with a 10%. In this case, yes, it becomes really a much safer option. Now, how do you get here? Of course, it depends on the spot price, the distance to the strike price. And so this is something that, of course, you need to keep in mind. Because even if the price does not change, the surprise is zero, and everything went according to the plan, depending on where the volatility lands after the crush, this can still make a difference on your position, and that's something that you need to consider and manage until the put reaches its maturity, or when you decided to buy it back. And so, as we saw, there are three main takeaways from this specific relationship. The first one is that assuming a constant level of implied volatility, you can see that both the Gamma and the Vega are pretty similar in terms of their behavior. They have relatively comparable or slim tails, and then towards the ATM price, they are very peaky, all right? And then the second relationship, that's when things start to diverge a little bit, is that when we increase the volatility, the Vega curve begins to have fatter tails, but the peak of the distribution remains relatively the same, which, if you think about it, is relatively understandable, because when you increase the volatility, what's going to happen is that the set or the range of possible outcomes increase as well, and this causes that the range of outcomes that own distribution can take increases as well. But when it comes to the Gamma, the interesting part is that the Gamma curve, of course, as well, the tails also increase, they become flatter or fatter, but on the other hand, the peak of the distribution, where the ATM price is, starts to decrease and starts to deviate towards the in the money region of outcomes. And so this has a slightly different behavior, but it's also a relevant one, because again, and this is the third conclusion that I think it's very important, especially again for those who sell options and like to take advantage of earnings announcements by companies, is that when you sell an option, and in this case, let's just say a put, because it's the most common case, when you sell a put and the option has a lot of volatility because of the impending earnings announcement, it is much better that after the earnings announcement take place, it is much better that the option reduces as much its implied volatility as possible, all right? Because by doing so, and let's just say that after that there is nothing else, there is no more volatility events for a long time, it's much better that the volatility decreases as much as possible, because as we saw, at that point in time, if the volatility decrease is very, very significant, then you will fall, the Gamma fall into that region in which it starts to go downhill as well. Whereas, let's just say, for example, that you have an earnings announcement and the earnings announcement take place, but then let's just say in 3 days time or 4 days time, you have another event, you have a CPI coming, or you have a Fed meeting coming. The inflation may not fall as much as you would expect, and as we saw, it may only fall enough for the decrease in the Vega to be replaced by an increase in the Gamma. And so your actual risk exposure that the option is giving you may not be, the decrease in the risk may not be as much as you might think, because the Gamma increased and so replaced some of the risk exposure that you are having, and that replaced the decrease in the Vega. And so it's much better that when the volatility completely crashes, it goes to as low as possible, because by that point both the Vega and the Gamma come down to an extent in which the associated risk of the option is no longer relevant, or is significantly reduced. And so these are the three main takeaways that I want for you to have in this relationship. In the next video, we are going to introduce another variable, which is the raw, and we are going to make a video between the raw and all the other Greeks that we discussed until this time. But for the time being, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And I'll see you in the next one.